You're not declaring a dividend, but I suppose perhaps understandable for shareholders in the investment climate that we are in at the moment.
Yeah, I think we've seen quite challenging times over the last 6 months, specifically in the area of government spend. We've seen a reduction. Interesting, because at interims, at Accentuate, we were looking very positive and still very bullish regarding government spend. January, February, the trend continued with increased margins, so we were looking very positive. But in March, we saw a dramatic slowdown, and that slowdown has continued through to the end of July. It is normalizing at the moment.
But some people will say that's a surprise, because government spend is what perhaps has kept the South African economy from seeing the worst effects of the global recession than many other economies.
Yeah, I think that's critical, and we understand that government spend is really the stimulus package for our economy. However, we did go into quite a difficult time regarding the elections. I think a lot of people were involved with that. Yeah. And then subsequent to the election, we've seen all the portfolios, government portfolios change, which meant that there were different political bosses. And I think that has just put government spending back slightly.
Yeah, multi-skilling perhaps not the government's best strength, as evidenced by that. You had a number of pressure points during the year. One of it was, of course, costs, with commodity prices surging as they did. Now, that is reversed. So are we seeing a corresponding decline in your input costs, and therefore perhaps better prospects for you going forward?
If we look at Accentuate over the last year, and specifically in areas such as the Floorworks, the flooring brand, we've seen a reduction in the region of about 6% of margin. That has impacted to the tune of about 19 million rand at the gross profit level. And that has severely impacted on the business. However, as management, our responsibility is obviously to manage these. We've seen global commodities coming back. And we are managing the costs, and we're starting to see our margins normalizing.
But these are margins that are still very healthy, but because I think we're looking at what, 47.4% versus 54%. Many people would say, give me those margins, man, I'll be very happy to take them.
We've always believed that we invested in a good area in the market, and we're very, very confident, notwithstanding the figures that we've put forward now, that the business is really looking very positive. If you look at our chemical business, Saffic, there's been a dramatic turnaround, and that has boosted and really protected us to a large degree against what has happened in the market.
Yeah, across the world, there's disinflation taking place across all economies. When you look at the kind of companies that you do business with, are you seeing a similar process taking place? Are we seeing companies' cost bases coming down to the degree that we're all going to see perhaps a slowdown in prices going forward?
I think realistically that is the case. I think we're seeing prices coming back. In some of the commodities, obviously, we're still having a problem. PVC is one of them. The demand for PVC is driving, even though your petrochemical prices are coming back. The demand for PVC in China is still at an all-time high. So yeah, there's a little bit of both. But at the end of the day, we are seeing cost pressures coming off.
You're talking about right-sizing and cutting costs on the business going forward. Is there a specific target that you're looking at in terms of getting the size of the business to? And does that preclude perhaps growth through acquisitions going forward?
I think when we talk about acquisitions, we have to be responsible under the current environment. The converse of that is that there's enormous opportunities presenting themselves, and we're constantly evaluating those.
Sure.
But as far as right-sizing, we as management have a responsibility to constantly remain globally competitive within our local economy, and that is our challenge. So costs constantly drive in our business, and there's a drive to reduce costs throughout.
Incredibly, your glass, as well as I think you call it's glass, as well as aluminium order book, is double what it was last year. How is that?
I think the point that we're making is, as management, we identify the problems, we react to it. I think our track record would state that. When you look at our chemical business 2 or 3 years ago, it was under pressure. We've turned it around. We promised the market we would. The glass and aluminium business, the contribution this year was definitely not up to the level we expected. We've put our efforts into it, and we are effectively 100% full till April next year. We've already signed up 200% of our last year's order book.
When I go through your prospect statement, I see positivity all round. Is that an accurate picture of your business going forward?
There's
and
no
is
doubt.
that dividend coming back?
We've given an undertaking that we'd review the dividend at interims. I just think that it's prudent at this point in time from a business not to be paying a dividend. However, we are exceptionally confident. We just need to understand that government's going to spend. The only challenge for us is government spending. If you look at our chemical business, well positioned, I'd almost like to say it's recession proof. The glass and aluminium business is definitely sold out. And on the flooring business, if government spends, we're going to have a fantastic year.